Hey, good morning, guys. Ken at Tortoise Capital. This is the Foundation's Q&A, a check-in for December 31st, 2023, getting ready for the new year. And everybody's sounds good, getting their mind ready for the challenges of the new year. Just to do a little bit of housekeeping here, we'll be starting up the book reading club next week. I think it's and small coaching group. One of them's on Monday, the other one's on Wednesday. I'm trying to remember which one, but I'll send a note out to folks that are registered for those. They'll be from 7 to 8 p.m. Central Time in this room. The book reading club and Q&A for that is free to you guys. And the small group coaching is going to look a lot like true storytelling check-ins for Creativity 202, in which the members, the coachees, are going to be developing projects to work on, and these are going to be weekly check-ins to see how they're doing, what questions they have, information they have to share, and then I'll be performing some coaching in some fashion, and we're going to see how that shapes out. That's going to start next week. And then the reading club, we're going to be reading probably a section a week, maybe 30, 35 pages worth of stuff. And we'll be recording the Q&As plus doing some Cornell note sheets that summarize the book into like a cliff notes with 1 page of notes per section. And that'll be a lot of fun. There'll be some folks joining from the Edge Raider community already, so there should be a lot of interesting and foundational questions. I'm noticing that I needed to have spent more time personally on the proofreading of the material because there were some technical terms they didn't catch that need to be corrected in the second edition. Nothing major, just need some clarity in writing. But we'll live and learn. So what this little note from Phil is concerning Edge Raider, and we were looking for some information for my brother's presentation on the 3-day, 9-day sniper. And the basic idea there is that we're taking the individual bars are 3 days or 9 days, but all of the things remain the same. And what we were interested in was simply finding the value of the PSAR as an indicator. So if I have something like this, every time there's a PSAR flip, there's a PSAR box. And what happens is that, price probably peaked up in here, and then it starts coming this way. And so we're just going to trade from PSAR to PSAR. So I'm long in this point until the price reverses and catches me out, and I end up getting short right here. And then using the PSAR box as the risk, now I'm short. until this reverses. And then I get long at the PSAR flip. And then I'm long until that fails. And then I'm short. So we wanted to just study the effect of the PSAR as like a foundational brute force indicator. Always in the market, either long or short, and so an exit was also a stop and reverse. So let me check with you for quick, make sure everybody's kind of clear on that. Clear on that we're testing a 3-day bar, and then a 9-day bar. Two separate issues. Everybody cool on that?
Are you doing any other qualifications such as harsh winter?
Nope. Just we are directional with the flow of the PSAR, and using the PSAR reversal, the price as the PSAR reversal to make the switch, and tested 3 symbols: EWZ, DIA, and SPY, and we're going back 5 years in each case, and using the entry and the exit as a PSAR. And just for purposes of the test, it was just using 100 shares. It was really to compute the winning rates and whatnot. And in EWZ, had 125 trades. The best trade was 23.7 R. The worst trade was -4. There were 77 wins, 48 losses, which gives you a 62-38. So that's a 3-2 win to loss rate. And the payoff was 2.2 to 1. And that's a trade that you want. That's like 6.6 to 2, or in other words, 3.3 is the value of the coin flip. That's pretty good.
I apologize. Is there any way to compare this, let's say, to a SPY performance over the same period of time?
That's the next one.
Yeah. Okay. Sorry.
Yeah. So that one is EWZ. That's Brazil. The S&P over the same period had a total of only 22 trades compared to 125. So not as many flips. The best trade was 8.6. The worst was -1.1. 14 wins, 18 losses. So again, 64 to 36. That's almost 2 to 1 win rate. And then the size of the average win was 2.2, and the average loss -0.63. That's like a 3.5 to 1 win rate. And so that gives you a 7 to 1 coin flip, whereas EWZ was 3.3 to 1. That's astonishing.
Wow.
Yeah. Now the interesting one is to me, and I'm not sure why it was so different, is DIA. That has a 2.5 to 1 payoff, but a 2 to 3 win rate. 2.5 to 1. And you would think that that would be closer because of the strong correlation between DIA and SPY. It's still positive expectancy, but the win rate is a little bit surprising to me. I got to go back and look at their numbers on that. The EWZ SQN and NSQN is 3.5 to 1. The SPY is 2.43 for the SQN. If you normalize it for 100 trades, it's 5 to 1. I mean, this is really pretty cool. And what was interesting was, as I told Phil when I wanted him to start back testing, I told him, just set it up in this way, and you're going to be glad that you did. There's one thing that comes through loud and clear with this, and that is trust the PSAR. I don't know if you need anything else other than that for your longer term investing, to be honest, is the 3-day PSAR flip with the S&P. How do you want a 2 to 1? How do you like a 2 to 1 that pays 3.5 to 1? I mean, good Lord. That may be the most important reason for you to have taken the taken this course. I was looking for his note on the for the 9-day, but here it is.
What are your thoughts on the practicality of this? Because I've done
100% practical, and I'll explain why I mean that. I would like you to just to think back to your COVID experience. How many of you exited positions in the stock market when COVID hit, when there was a 40% sell-off within a matter of 3 weeks? Let me tell you how many. Let me tell you how many people in the world did. A shit ton of them. I got to go back and edit that out. A ton of people exited the market during COVID. And the hardest thing for people to do was to have exited the market, except for getting back into the market. Now, one of the things that this strategy does is it gets every major move correct. Like it gives you, let's see here. It gives you this move. Oh, by the way, it gives you this move. So how practical is that system? You're long here. You're short here. You're long to here. You're short temporarily. You're long here, etc. The dollar value of that trade right there is off the chart. Even if all you did was reduced your exposure, that's a 5-hour trade. There's 4. There's probably another. so what you're looking at is a market condition indicator. This is 5R if you don't use markets money. And a guy who was buy and hold gets this whole move here. But this guy gets that move plus this move. And then I know a lot of people that ate all of this and then couldn't take it anymore, so they got out of the market and then waited until up in here to start getting back in and missed this move. This was like the move here from 200 to 450 is 125% move. So the practicality of this, yeah, this is enormously practical. And this is on a three-day chart. And there was one bad time in DIA. It looked like there was one 4R adverse gap, which is why I'm not sure that they did that right, because that would really be surprising. And then in EWZ, let's see if I went back 5 years, you also get the let's see, this is the Trump shenanigans in here. You get turning points correct. That really adds up over time.
What's the magic of the 3-day? My question was on the fractal nature. If it works on the 3-day, should it?
Oh yeah. The 3-day smooths everything out. It reduces the impact of gaps, so you can actually you end up having a wider stop on a 3-day, because you're essentially doing this, right? You end up getting one bar that looks like that. So that compresses into this, and so you only have 1/3 of the gaps, and because the size of the box, the 3-day move is larger than this. But it's only gapping on a daily bar. There's actually some protection against overnight gaps baked in, and then on the 9-day, it's even more pronounced.
So are we saying that the 3-day is probably the lowest time frame that you'd ever apply this technique to?
Well, I actually use it on the 1-day, but what you get if you're using the 1-day bar, it's you're gonna end up seeing some SFCs that fail, and then a kata 2. So you'll get an SFC on especially after these big catastrophic moves like this. Those are never V bottoms on a 1-day, never. And so you'll end up, your rule set will get you in on an SFC, and maybe the first one doesn't work. It's not until you get the kata 2 entry that thing starts becoming kata 2s all the way up. Like if you look at this little section through here, there's a lot of kata 2s. This little waveform, you're getting this kind of action. So kata 2 is great in here, but what the 3-day does is really smooths out the turning points of major exits. And the psychological challenge here for traders is when to get out, and then after it turns, when can I get back in? So something you can do is you could say, let me use a 1 day, 3 day, 9 day program of behavior where maybe I start with a 3 day. When the 3 day gives me a signal, maybe I can put 25% of my position on, and then start day trading with 1 day, and when the 9 day turns, put another 25% in the final increment, and then maybe this is 50%, or maybe that's 25%, and then this is 50%. If that was your long term, if that's your long term estate money, that's not dumb, because now you get an actual. You can start fine tuning with this piece until the whole thing turns. Then, somewhere around here, when it crosses the Bollinger Band mean, you're pretty sure that the pain is over. And then by that time, the 9 day will have turned, and then you could put the remainder of your portfolio in and then comfortably ride that whole thing. So the fractal nature of this allows you to start using increments. Instead of all in or all out, you could actually start timing it. Now, we didn't back test that, but there's an infinite number of ways to do that. The point of this thing being that allows you to get the overcome the psychology of fear. I will tell you this. I've been writing a newsletter for folks with that essentially blended monthly rebalancing since 1996. That's 27 years. And I can tell you that the most difficult ones to write are when to reduce exposure. That's a hard one to write because it's a fight against buy and hold. Because now you get fear of missing out. And the pressure I felt writing for a lot of people that were following my information, following my education, if I say that, not advice. There were guys that were, putting their entire retirement portfolios into that. So that was the number 2 stress on me. And then in the last 25 years, there have been, the internet bubble, long-term capital management, real estate, financial crisis, and then COVID. Those 4 elements have all caused the S&P to lose greater than 50% in a very short period of time. And if you're in your 60s, it's hard to recover from that. So when you're writing a letter for people that are following you, the number 2 level of stress I've ever felt was, and I remember how hard it is to push send, was to reduce exposure because of market conditions. Like right here, it's hard to tell people to get out, especially when the previous move was up so strong. But the one that was harder was the one telling them to get back in right here. Because I'll tell you what felt like euphoria was when I saw this move and their retirements are not getting punished. That was a really good feeling. I didn't forget how hard it was to do this, but it was sort of like a great relief to have been able to say, yeah, the whole world is suffering, but our guys have taken shelter. But then the hardest thing to do was then telling them it's time to re-enter, because there was a certain comfort of, hey, look at all the pain and suffering that I avoided, but getting back in and starting to battle, that's the hardest thing to do. And in those 4 cases, even though we had avoided most of that, when I say most of that, damn near all of it, like in the internet bubble, our biggest drawdown was minus 6%. And that's when the Qs lost 80% of their value. Those of us that are old enough to remember. So the practicality of this is significant, I would say. Even if you just use it as a market filter and market direction, it's a pretty good guide for seeing where you are in kind of the season. And now this should show you the winter, fall, or I'm sorry, the summer, fall, summer re-entry, if that even got you out. There's a COTA 2. So, yeah, that's strong. Good. Greg, you had a question about exit?
Yeah, so what you're saying is we're not, for this particular strategy, we're not getting out at all until
Ever.
the PSAR flip. So when price crashes to the PSAR,
Yep, you short. Yeah.
no, just to confirm. So for example, in November, I'm touching it like you can see. In November, you see how price crashes through the PSAR?
November.
Middle of the screen.
This one or where?
To the left. Far, yes, sir, right there.
Yeah.
So
Yeah.
theoretically, you would still be in on a long because you're waiting for that PSAR to flip.
You're long here. When this goes here, you're
Yeah.
long. You're short
Right.
until it goes here. You get long for a week. You get short. No, yeah. See, this one didn't flip. Sorry. Looks like it's when the RL10. I get this one. It may have been, you may have gotten short. I think he was using the price, so you would have gotten short here when price hit it. But then you get long again, right here. So this was a little bit of in and out in the sideways in that chop.
What's the reason for him using price versus the RL?
I think
Is it
this edge rater.
okay?
I got to
Okay.
check with him. This is one where I'm not looking at the trade stats, but he sent me the list. I just got it this morning. But if he used the price, then he got short here, and then he got long there when it goes back through the PSAR. But this one is geared on my screen. I have it geared to using the RL10 as the value. If I were to use his, let me see if I.
And in a perfect world, we're talking that we'd also layer on the 2R battle drill, adding a position.
Those things. That's the next form of research. Is that you just start. What is your? You start if you start adding multiple criteria, and if you say the long-term buy and hold, you just simply hold it. You bought it, and then whatever it is at the end of the test, that's what you get. And then this one tests just if I just use parameter 1, the PSAR flip. In the S&P, it's a 2-to-1 win rate and a 3.5-to-1 payoff rate. So if you have a pool of money, this is better. It's not even close. And then there may be other ways you start thinking, well, what would be the next thing that I put on there? Well, maybe I pick the 2R battle drill to start adding positions. Well, then if you're doing that, then it gets a little more complex with your money management strategy, because you got to say which pile of money is this, because this one has all of the money in every time. But if I'm using a 2-hour battle drill, then that means in the first 2 hour I didn't have all the money in. So what could I do instead? I could use options. I could use futures with leverage. You know, when I show this to options guys and futures guys, they're salivating. So this one could also give, the next one might be sniper exit in order to preserve abnormally large wins. And then this one might be turbo, where when the 3-day is showing maybe I have a certain amount of money on the 3-day, that's my long-term horizon, and I use that as a time to answer the question, when should I turbo? Yeah, when this thing is long, it tells you what direction you should be turboing and whatnot, and when to activate that. So, as a market condition, this gives you timing and directional bias to that degree of freedom. Now, I'm just going to compare that to Van Tharp's market condition thing, where he uses the idea I gave him on the SQN, and he does a system quality number, and it has 4 different tiers, and then as the system quality number goes through that, it has like bear, sideways, bullish, very bullish, or something like that, or maybe it's very bear, sideways, bull, or he calls that normal or something. It's not actionable. It doesn't give you anything like this does. So the point I make in I was recording some of the audiobook earlier, and in the opening section it talks a little bit about market conditions, one of the big ideas. And your market condition indicator, it should be timely and action oriented, and it should be, what I mean by timely is that it should be geared to how long you plan to be holding positions. So if I'm a day trader, and I'm working on 3-minute bars, I probably only need a 2-day look back period, because I've got 27. I've got 150 bars on each day, or something like that. Does that sound right? 6.5 hours times 120. So when I'm on a 2-day look back period, it peaks and it goes to the bottom and starts coming up. That's all the market condition that I need for a day trade, is because I can now say, this feels like, as long as this is the 2-day low and it's starting to move out from a minimum manageable risk box, I can trade that for the rest of the day with an expectation that it could get back to the previous 2-day high. That's why on the daily report you see that I have, on the NDX, I include a 2-day NDX, because that's helping me figure out that's the market condition for 3-minute charts that's timely, and it gives me enough distinction that it gives me clear action signals, and with enough room to be able to manage the trade. Like, there's no point of me as a day trader saying, hey, price is greater than the 200-day moving average, so we're in a bull market. Dude, you could have 9 days in a row down and still have price better than the 200-day moving average. And if you had a long side bias as a day trader, you just missed 8 or 9 days worth of collapsing dragon moves intraday. So if you're a day trader using a market classifier like this, doesn't make any sense. If you're a day trader, you should be looking at a 2-day look back in the 2-day NDX, and you could look at the MACD 4 seasons that are timed to the chart. That's one of the beauties of the MACD 4 seasons as a market classification, is that you can it adapts perfectly to the time frame that you're using, and it's one indicator that always means the same thing. If that's your zero line, all of that's driven by the price action you get. Winter is always winter. Spring is always spring. Summer is always summer. And fall is always fall. It's always the same thing. Like at this turning point, I go up and I'm looking for SSCs initially, and then I'm looking for Kata 2s all the way to the top. And then when it peaks, what I'm looking for is summer, fall, summer. Except if it fails into here, then I'm looking to be massively collapsing dragon. And this little summer, fall, summer, fall, summer, fall, summer is why Kata 2 is such a powerful instrument, powerful system of thinking. Check her home.
Okay. Are you using on the logistics of this? Are you using a separate account and then just trading this sort of long, or the idea is to trade this long term,
Yeah.
and then use a different account to do
Yeah.
the nitty gritty? Because you might be taking counter positions on a smaller time frame.
Yeah, I have I have several retirement accounts with different brokers. And I have my kids' 401ks and my wife's retirement accounts. Like I've got a TSP with the Army, and the only symbols that I have in there is SPY. I have the G fund, which is like, it's an enhanced TLT. I get EW, or let's see, EFA, and I think it's I think there's a Russell 2000 in there. But those are the only four, and I have cash. So I only got 5 choices in there. But I maximize my contribution to that because they match me percentage for percentage up to 6%. So the first 2% of my money gets no match, and then from 3 to 7% they match. And so if I put 7% in, they add 5%. So it's that free money right there means that I'm always putting that much of my paycheck in, and I use this essential model to either be, I think it's IWM or the G Fund. And I've been doing that for 24 years. So I always know what the exposure of that thing is, and then then I have a self-directed IRA that I end up doing a lot of active trading with because it's a Roth. And so the money that I put into there was taxed first, and then the output of this thing is tax-free. So I actively trade the shit out of that because I have no capital gains tax. And when it comes out, it's tax-free. And then I have several brokerage accounts. One for futures, and then one just for trading. Another one for short-term trading. And then I actually use this one for very long-term trading because of the tax consequences. So this one is one that I would use as the 3-day, essentially buy and hold with a quick flip as needed. Because that one can hold positions for a long time. I get a chance for no capital gains. But the retirement ones, I can trade more actively. So when I get a signal on these longer term systems, I got to take it over to the pool of money and do the right thing based on which account it is. But it's end of day signals or end of the week signals or end of the 3-day cycle. So it's not that hard to do. Does that make sense?
It does. And normally I have my charting platform open all the time, just connected. And for this particular system, since it's 3-day, you're basically saying visit it at night or something like that because
Yeah.
you're
Like
waiting for it.
Yeah. Like in this period, like in this period right here, and I'm going to assume that this didn't exit because the PSAR didn't exit because I don't exit there. But if I get long here, while all this is happening, my stop is down here. That's 60 days where it takes approximately 2 seconds a day to see what are we doing. Hey, what are we doing? We're not even close. Okay, no problem. You know what I mean? So there are things that I got to do. There are routines that I got to do every day. I got to check this. I got to check that. Got to check the other thing. Then there's things that I only got to do every 3rd day. And then on the 9-day, 7, 8, 9, I only got to check that out here. But all these days, I'm working, checking some things. Like I do extra reports on Friday nights for guys that are following the weekly. But every 3rd day, I only got to do a certain set. And then once every 9 days, got to do that. In the same way that the blended monthly rebalancing, there's only 12 moments a year where I got to do something, right? All right, any other questions on that? Or any questions on anything else? So We're going to go further into that on the 9-day. He may have sent that to me, but I didn't see it on the screen. But,
I wonder if there will be a comparison of like equity curves compared to the buy and hold. I think that's a very good visual.
I'm pretty sure it does, but I mean it's relatively easy to do. Let me see. Oh, there you go. Oh, there's a cumulative R on the right hand side of the screen. Yeah, and your equity curve is going to vary based on how you use it or not. But the point is that that little back test, took a couple minutes to set up and run, and it shows you that there is a massive advantage that come from the insights. So it's worth exploring in your particular situation. So that's worth knowing. The main point I want to say on this is that just once again we have insight available that the PSAR with the RL10 has massive advantages and can be trusted. Yeah, go ahead.
Do you know if their Phil was going both short and long or long only?
Yes, long and short. Because I wanted to see how that thing performed in both markets. Because so now we can take a look at just the long trades and just the short trades, and then understand something even more about the markets. And what it's going to show is that you get, on the long side, you get something like this kind of a grinding move, and on the short side you get short, sharp moves, long, slow moves, short, sharp moves. So when you get those signals, you may not want to be long and short. You may not always want to be in. You might want to just be out and then wait for that thing to reverse and then just be enjoying cash. You may not want to be an active trader. Oh, you know when else this is going to work? So if you take a look at Jim Carroll's presentation from the research weekend, where he's using VXX and UVXY and all that, you know when those things really explode? During those periods. So you may not want to be longer. You may want to just use this as a say, hey, it's time to go to the volatility instrument for a short period of time when the fish are running. That's like in the springtime when salmon are swimming upstream. So here's the river coming out of the mountain, and the salmon are swimming upstream to go lay their eggs in some tributary, and they have to jump to get up over the hump to swim upstream. And that's where the bear is sitting with his wide open mouth, and the fish jump into his mouth. They only do that in the spring, for a week or so. So what should I do for that high priority week? I should go and trade the thing that's the best payoff for that week. Yeah, but Ken, that only works 2 weeks out of 52. So I'm not going to do it. Oh, okay. That doesn't hurt my feelings. But for the 2 weeks that the salmon are running, that's where the bears go. And then when the berries come into bloom late in the summer, they go eat berries. And in the wintertime when nothing's growing and they're big and fat, they just sleep. So they have adapted to the seasonality, and they find the trading instrument that's optimized for them and their metabolism and the weather. You know, if I can say it that way. All right. Now, were there any other generic questions on any other topics? We got a few minutes yet. I have us at 10:05. Any burning questions?
No, thank you very much, and have a happy New Year.
Yeah, we're going to do more with that, but it was so good that I wanted to make sure that you guys were aware of that situation. Yeah, and again, what makes this powerful is the way it can be applied to a lot of different kinds of systems, because it's really a fundamental insight. And you know, the lineage of this idea is that the RL10 is price. So instead of a very volatile bar, that gets reduced to a single dot. And so every day you know, you've got 10 bars of price that are collapsing to a single point, and then you add a bar and drop a bar, then you get a new point, and that shows the net change between, you know, this regression line and that regression line. So that compresses a lot of information. And then when you use that as the source for the PSAR, you can get some very nice long curves when the PSAR dots start working. And that makes the turning points very significant. And that's what that little research study shows. Is that those are very significant turning points. You can call that, you know, a critical state or a compound critical state. And if you get that right, you're going to have an extraordinary and a persistent advantage.
I mean, in the back of my mind, it feels like a moving average cross system, like of a 10
Oh,
and
it
the
is.
30.
It's a PSAR crossover system. 100%. And it's not a far move to realize that, you know, when the RL10 is doing that, and the RL30 is doing that, that this conformation is really important, because when the RL30, when that slope starts moving up, you have the owl entry somewhere in here. Somewhere down in here, you know, you have an SSC. Somewhere in here, you have the dragon crossover, you know, for the for your SSC. And then when the RL10 is greater than the RL30 and the slope is up, this is prime time growing season right in here until you get that alert. You get that confirmation. And then here, you get an owl move to the downside. And here you're getting a supported fall crossing somewhere in there. And in the same way, when everything is falling together, this is prime time, collapsing dragon time. Until it can't. So while this is falling, you have opportunity trades. And then if this breaks, you have massive collapsing dragon. So that little sequence you get at every major turning point. So that's sort of our SSC, collapsing dragon, Kata 2 battle drill. And realize that that whole thing is happening inside the major turning points of the market. But this is the one that sort of gives you the no shit long-term directional bias. When that flips, you should have a directional bias. So yeah. All right, that's everything I got for today. Then you guys have a good New Year's. We're gonna maybe watch a little soccer and some football and dinner with friends, and enjoying the day off. Tomorrow I got to record some more of that book. Oh, killing me. All right, take good care, guys. Last chance for questions. Hearing none.
Happy New Year.
Happy New Year, fellas.
Happy New Year.